And in our top business story, figures released by the Dubai Statistics Centre has shown the inflation rate in Dubai rose by 0.76% in June compared to the previous month. According to the centre's report, the prices of commodities in the food and beverages group rose by 2.15%, the transport group by 2.09%, clothing and footwear group by 1.57%, while the restaurants and hotels group rose by 0.45%. The Dubai Statistics Centre added that the index for the group of housing, water, electricity, gas and fuel rose by 0.39%, while prices of furniture and household items rose by 0.31%. The annual inflation index of the prices of goods and services in the consumer basket rose by 2.23% in the month of June 2016 compared to the same period of 2015, with the rising cost of tuition fees pushing up the prices in the education group index by 6.74%. Thousands of affordable homes next to the Dubai Expo 2020 site are likely to go on sale in October, after the government-owned master planner Dubai South awarded 1 billion dirhams worth of design and infrastructure contracts for the high-profile residential district. Atkins Global, Studio International Architects and RNL Design have won contracts to oversee the master plan for the district, which will comprise about 10,000 middle-income homes by 2020, housing about 35,000 residents. A first phase, which will encompass 6,000 homes, including apartments, villas and townhouses, is due to be completed in 2019. The project will also have schools, community facilities, entertainment, retail and hospitality options. Parsons and Keel Constructions have been awarded contracts to build the first phase of the project, Sakani Staff Village, which is expected to accommodate 20,000 residents by 2020. According to local reports, Dubai South, which was previously known as Dubai World Central, said contractor Al Nasser had already started work on completing infrastructure of the first phase of the site, which is scheduled to be finished by the fourth quarter this year. TriStar Engineering and Construction has also been awarded a contract to complete the remaining infrastructure for the first phase of the project, which is scheduled to be completed by the end of next year. Real estate investment and advisory firm JLL today has released its Q2 2016 Dubai Real Estate Q2 Overview report that evaluates the impact of Britain's exit from the European Union on the Dubai real estate market. The report, which studied the potential effects across the office, residential, retail and hotel sectors, stated that as Dubai caters to the most open real estate market within the region, it is more susceptible to external factors, with Brexit bringing a degree of uncertainty into the market. While the report noted that in Q2 2016, rent values continued to face a downward slope in the office and residential sectors, Craig Plum, the head of research at JLL MENA, stated that even though it is too early to predict the long-term implications, overall there is a slight probability of British investors being negatively impacted by the devaluation of the British pound following Britain's decision to exit the European Union. Data from Dubai Land Department shows that British nationals are the third largest investors in real estate in Dubai. But according to JLL, the effects of Brexit on these investors will have only temporary repercussions, as a substantial number of British investors who work and reside in the UAE avoid sourcing their income in sterling. The report added that in terms of the residential market, expatriates in Dubai are most likely to continue renting the homes instead of switching to ownership, resulting in sales being more negatively affected than the rental sector. Meanwhile, JLL sees the Brexit decision as having an adverse effect on the retail and hotel sector due to the devaluation of the pound, which has the effects of making Dubai and the MENA region as a whole an increasingly expensive destination for European visitors.
When we talk about tenancy and especially like foreigners continuing to rent, this is primarily due, which we believe is because of obviously the very compelling story of Brexit, which made a lot of highlights during last quarter. So what we see will happen is that obviously, like a lot of decisions which are made on an investment front, it's all sentiment. It's driven by sentiment largely, and especially when you're looking at the residential sector. So we believe that a lot of tenants or occupiers of certain homes will continue to rent these properties as opposed to switch to ownership until there's more clarity on what's happening on a global front. I mean, with all the sectors, not just hotel, we don't believe that what's happening currently is like a longer-term impact on the market. We do believe that it's all just in the short, max to the medium term. We don't believe all these impacts will hinder any future developments which Dubai is expected to see. It's more like immediate impact which the market is currently witnessing. I mean, assuming, well, obviously for each sector, it will be a little different. So if we're looking at the residential market, for instance, we are expecting that, assuming no further, obviously, external factors play into account, that we are assuming that the residential market should start picking up by the beginning of 2017. And the reason why we say this is because Dubai, as opposed to like other economies in the GCC, is the most open, which is why we tend to believe that it will be the most impacted in this part of the world if anything were to happen on a global front.
Emirates NBD has reported a 12% increase in profits for the first half of the year as lower levels of bad debt allowed the bank to reduce impairment charges. The UAE's largest lender announced net profits of 3.7 billion dirhams for the 6 months to the end of June, compared with 3.3 billion dirhams in the same period last year. According to a statement, the bank made a net profit of 1.91 billion dirhams in the 3 months to June 30, compared to 1.65 billion dirhams in the corresponding period of 2015. Emirates NBD added that its impaired loan ratio, reflecting the level of bad debt on its books, fell to 6.6% at the end of June from 7.4% a year earlier. This in turn enabled it to reduce allowances for impaired debt to 1.456 billion dirhams, down from 1.986 billion dirhams in June 2015. Emirates NBD's loan book grew 12% to 286 million dirhams at the end of the first half of the year, while deposits grew 8% to 297.6 million dirhams during the same period.